Ever since I invested in WarnerBros Discovery, the stock has only been going down. I have invested in the company even before the merger, when it was only Discovery. And even then, the stock was crashing. So it's not really just the merger that is causing this stock to go down. The merger only made it worse. Since the merger happened, the stock is down by over 50%. And since I invested, by over 70%. So it is important for me to ask the question, what to do next? Should I be worried? Should we be worried with this investment? Of course, I did not invest everything all at once. And if you look at my performance in my portfolio, I'm not down 70%. I'm down less than that. But still, this is a very important question. And now it is important for us to look at why the stock is falling, to understand what's happening to this stock and whether or not we should be worried. What initially caused Discovery stock to fall, I'm not talking about WarnerBros Discovery, just Discovery, was that the stock just went up because of some derivatives that Archegos Capital were investing in. And then when everything crashed, when Archegos Capital had to file for bankruptcy, when they had a margin call, everything crashed, all their investments, including this one. So then I look at the company, it was undervalued, and I took the opportunity to invest in the company. One of the main reasons why I was investing in the company was because it was a factual TV network. Their main channel is of course Discovery, but they own Eurosport and other things, but all of them are factual. So they are less cost instead of, let's say, paying actors to make a show. So factual shows are always less costly compared to fiction. So that's one of the reasons why I was investing in this company. And besides, just like the competitors, Disney, Netflix, they're all entering streaming. Even this company was entering streaming. So I was investing in this company for this reason alone. It was factual, it was undervalued, and they were entering streaming. Of course, this was something new. It was going to cost them money, but eventually, over the long term, it was going to work. But I was not expecting that much growth, because you have to understand, if people in general, they don't watch only factual, they're going to watch both fiction and factual. So if you're a TV network, a media conglomerate, and you provide only factual, maybe over the long term, this is not the right thing to do. It's better to have some fiction. That's why I like this merger, the merger that they were going to do with AT&T's WarnerMedia. If they merge with WarnerMedia, there's going to be HBO, there's going to be the DC network, there's going to be CNN, all of this is fiction. So the growth potential for the company would be higher, but of course the margins of the company then would be lower because they are producing fictional shows which cost more money in general. So you have to make the compromise, whether you want the company to grow or you want it not to grow that much but have higher margins. If you ask me as a value investor, I have no issues with the company not growing. The company is undervalued. I have no issues investing in a company that is not growing. Investing just because of the current business. But you have to understand the management team. Of course, they want to grow. So if they see that with the business they have, growth is limited, maybe it's better to make this merger where growth can be higher. So I decided that I could keep investing in the company, wait for the merger to happen. When the merger happened, the stock kept crashing, and it crashed more when they reported their first earnings. These earnings were not so good. And the reason why it was not so good was because the company has been spending a lot of money to clean up WarnerMedia. WarnerMedia itself, it was owned by AT&T, and only in 2018, AT&T acquired WarnerMedia. They took a lot of debt to make this acquisition, and in some way we can say that AT&T ruined WarnerMedia. WarnerMedia was a good company, not such a great company, but it was a good company. So they merged with AT&T, and AT&T put a lot of debt on the balance sheet of WarnerMedia for this acquisition, and things did not work so well. That's why it was better for AT&T to sell WarnerMedia. If you're wondering now why will Discovery save WarnerMedia, it's because Discovery is a 100% media company. This is what they do. So the merger would be better, in my opinion, compared to merging with a network operator. It's not the same thing. Whenever there is a merger, there are always going to be costs. Some businesses need to be closed. For example, CNN Plus was shut down. And I think it's good that the management, I've always said that David Zaslav is one of the best CEOs in America. This management, what they're doing, they're trying to put all the costs right now so that in the future they don't have to spend that much money into this merger. It's better to do the cleanup right now, and then in the future things will be better. Instead of If you have an issue today and you keep this issue after 3 years, it's still here, you try to save it, you spend a lot of money trying to save something that cannot be saved, of course, most probably it's not going to work and you're just going to lose a lot of money on this. So it's better to close in, and plus, of course, they have to fire people. There's a lot of costs involved with everything they're doing, a lot of expenses. They're going to lose money, but it's only the short term. What we as investors we are looking for is the long term. And that's the reason why I invested in Discovery. That's the reason why I invested in WarnerBros Discovery, that I kept investing even though this merger happened. It was for the long term. And this is what the management is focusing on, the long term. Because they want this company now to grow in the long term and compete with companies such as Disney or Netflix. And I believe they can do it, they can compete. There's not going to be only one TV channel over the whole world, one streaming platform. All of these companies can have a market share. Now to answer the main question of the video, should we be worried? It's not because we are saying that over the long term, we are not worried about the business, that we should not be worried about the stock, because maybe it will keep falling. In the short term, if let's say the company is really spending that much money and it keeps falling, they have to take debt, things will of course get worse. To tell you whether we should be worried or not, let's talk about another company, Apple. I invested in Apple in 2016. In 2016, the stock price of Apple was crashing. Back then, the main reason why it was crashing was because iPhone sales were not growing. Smartphone sales in general, they were no longer the largest smartphone producer in the world. And people were worried that Apple could not make money anymore. Of course, we know that this did not happen. They are making money from services, and even if iPhone sales are not increasing that much, it's not something that we should be worried about. So why did I, as an investor, decide to invest in Apple? It was because I was focusing on the business. Even if we look at the worst case scenario, that this business doesn't grow, even then, Apple at the price at which it was a good investment. And that's why I invested in the company. We can talk about another company, GameStop, which was a deep value stock. With GameStop, it was different. Maybe the company was not going to recover. It was a cigar butt stock, but still there was value. It was trading under its intrinsic value. A third example, I can give you a company I currently have in my portfolio, and that is Geo Group. You look at the stock, since I've been investing in the company, it has been going down. You look at Apple, you look at GameStop, it has been going down. On GameStop, I was down 60%. Even on Apple, I was down, and Geo Group, I was down. But all of these stocks, eventually, they recovered. So this is what value investing is about. If you're investing in the business, you should not be worried what will happen to the stock. Most stocks that I know, value stocks, eventually they recover. They don't go to zero. A company that has a good balance sheet will never go to zero. How do you think that WarnerBros Discovery will file for bankruptcy? Of course, if they start taking debt, then even I will sell the stock. But things are not that bad right now. The business itself, yes, they are not making that much money because of this merger. Revenues are here. We are in a recession. Revenues are not as big as it should have been. But if you're thinking about the long term, the economic recovery, these expenses they have right now with the merger are gone. Of course, things will be better. And if you focus on the fundamentals, right now the company has 1.6 billion US dollars in free cash flow a year. I believe it can go to over 8 billion US dollars in free cash flow in 5 years. So an increase of 5 times. 8 billion US dollars, this is a conservative estimate. The market cap of the company today is about 27 billion US dollars. So even in the worst case scenario, let's say the market cap doesn't change at all, it's still 27 billion US dollars in 5 years. But 27 billion US dollars and we have 8 billion US dollars in free cash flow. That's a price to free cash flow ratio of 3. This is undervalued. Of course, the market is going to buy, investors are going to buy the stock, and eventually it will recover. This is how value investing works. There are always going to be those that are going to be early in the game. They are looking at the business, they are not worried about the stock price. Of course, if you look at their portfolio, they are losing money, but eventually other investors will see it, speculators will see the stock, and when they are buying, those people, they are going to push the price up. And you, if you are one of those people who bought early, you take your profits. Of course, you have to be careful. Don't just buy because the stock looks undervalued. That's why we take a margin of safety. Actually, I made a mistake when I first estimated this merger between WarnerBros and Discovery. When I calculated the free cash flow that was possible for them to generate the revenues, I didn't overestimate. It's okay because I did not know that they were going to sell CNN Plus, for example. There are so many businesses that they closed. So I was not taking all of this into consideration. So it's okay, you're going to make mistakes. How do you minimize the effects of these mistakes? Is by taking a margin of safety. So if you want the full analysis of Warner Bros. Discovery, you can find it on my research platform. You can also have all my analysis there along with my investing course for beginners. If you're interested, you can have a 1 month free trial. And we know that the future right now is streaming, so it is important for all of these companies to go into streaming so they can spread their shows more directly to consumers. Talking about spreading, please make sure to smash the like button so that this video to spread for the YouTube universe. Another stock that I can give you an example that is crashing right now, but I'm not worried about, it's Meta, it's Facebook. So I will suggest you watch this video next about Meta. Have a nice day and goodbye.